there's a couple of different ways to look at profit targets, right? You can say you want to make 50% of the credit you receive, right? That's one way.
Yeah.
You can say we're going to manage a 21 DTE wherever it is. That's like one of the things we do, right?
Yep.
Those are, I wouldn't call either of those two dynamic. Those are kind of like static, right? You're either managing at 50% or you're managing at 21 DTE. But what if you just gave a little flexibility? Like, what if you made more money sooner? Like, you put a position on today and it actually worked.
Okay.
All right. That would be something. So if you want to take profits, let's say 25%, that would be dynamic, right?
Yeah, I got emails about this last night. Volatility's contracted. They caught a good volatility run here, and they're saying, hey, do I wait to 21 days or do I close stuff? So this is very timely.
Let's take a look at the first slide. So when it comes to option trading, management mechanics can make all the difference. This is one of the key takeaways that Tony and I have learned in the last couple of years, that the management mechanics make a big difference. At Tasty, we generally favor locking in profits, looking at the 50th, looking for 50% of the credit received for a short option position. But is this too rigid? That is a good question. A common scenario is a trade that makes a good profit, but shy of the 50% early in its lifespan. Should we capture 25% profit after 1 week, or should we hold out a bit longer? Let's explore the effects of adjusting our profit targets, looking for more profit from trades that stay on longer, and be willing to take a quick buck when things go really early. That would be kind of the definition of dynamic. Let's go to the next slide. So 15 years worth of data, SPY, Qs, IWM, 30 delta strangles, 45 days to expiration, contrasted the results of several management techniques. Closing positions at 50% of max profit, waiting 1 week to avoid closing tiny winners immediately after opening them, and then closing positions if they reach a larger percentage of max profit, of the maximum profit percentage of the duration that had elapsed. So what all that means is, if you make money in a shorter period of time,
what does all that mean?
It means if you don't get to 50%, but you make like a prorated, like you make 25%, instead of getting to 50% in 24 days, let's say you get to 25% in a week or 10 days. You take your profits. Okay, that's dynamic. And then there's closing positions at 21 days, win or lose. And then there's also leaving all the positions in through expiration, okay? So there's 4 choices here. 21 days, expiration, dynamic, or 50%. All right? You good with that?
Okay. Yep.
Okay, no, I just want to make sure we're good. Okay. So let's go to the next slide. All right, so this is the SPY. Now, interesting. Remember the 4 columns. 50%, 79% of the time. Dynamic 82, 21 days 75, and expiration 68. We're going to rule out expiration because we don't do that at all, right?
Sure. We're not going to hold to the end of the
We are kind of the 21 days would be, I would say that we're between dynamic and 21 days. What would you say?
Agreed. Dynamic in 21 days.
Okay.
And a matter of fact, on my podcast, I'm more dynamic than I am 21 days. But sure.
Okay. I think I'm more 21 days, but it doesn't really matter. We're in kind of agreement. When you look at these numbers, 50% kind of is pretty good. The 21 days has the lowest CVAR, which is where we are. That's what we're trying to do, is reduce the risk. But so that's impressive. But none of these are supposed to be dramatically better than anything else. They're all supposed to just have their, like to give you some insight into what do you think is optimal.
Yep.
So for the SPY, I'm pretty happy with the 21 days that we do because of the low CVAR and the decent win percentage. If you're dynamic like the bet is, you're going to be fine with the higher win percentage, just less profits because you're managing early.
Yep.
And if you're waiting for the 50%, you can't complain about that either.
Yep. Agreed.
And even expiration in this case worked. Let's go to the next one, John. So the next one's IWM. Now, the first thing you notice about IWM, it's a smaller product, all the numbers are going to be lower. The weird thing here is that the 21 DT here, the win percentage a little lower, but the profits are higher. And the C bar is lower. This one, 21 days in IWM, seems fine. But if you did the 50% and you did the dynamic, those are also fine. Like BAT would do dynamic here. 85% and $23 is better than 50%.
Sure.
With a lower C bar.
Right. I just like ringing the register on the podcast trade just to show people that you can do this.
Yeah, I understand. Ringing the register.
And then you make your judgment from there. Maybe you don't have as many positions that I have on and you'd like to, hang in there a little bit longer. But at least our whole thing is about doing something actively. And sometimes doing something actively is doing nothing. But you're not just setting it and forgetting it. You're actively watching your portfolio, which is what I want people to do. I mean, so many people have investment advisors, or they just put things in funds. They don't even know the symbol to the funds that they're in, or what they have on, or if they're even mirroring the market. So I like you to watch. I want you to be active. That's what I'm trying to do. Look for opportunity.
Let's go to the next slide, which is the Qs. And in the Qs, it's weird because they've had such a big up move, that the P&L numbers are just not that good for strangles. But here, you'd be, again, the 21 days stands out as the lowest CVAR. But from a profitability standpoint and a win percentage, the 50% or the dynamic is, I mean, personally, after looking at these, you got to go dynamic or 21 DT. The 50% sounds good, but it's hard to know what that is after all the adjustments.
Beautiful.
Let's go to the next slide. So some of the takeaways. The dynamic management averaged closing trades with around 23 days to expiration for both SPY and IWM, while failing to outperform the 21 DT management. But for more volatile things like the Qs, being willing to rapidly capture modest profits resulted in closing trades with an average of 31 DT and improved your trade P&L. Dynamic profits were a reasonable alternative to hard and fast 50% goals for the active trader who does not depend on limit orders, but only early management, win or lose, was a substantial safeguard against bad losers. I think one of the things that the research team pointed out here is that you can see how close all of these results really are. And I would say that there isn't a clear winner, except holding to expiration doesn't really make a lot of sense for us. And the problem with 50% is that it's hard to tell what 50% is after you've made a bunch of adjustments. So managing the trades early and dynamically, or doing it at 21 days makes the most sense to me.